once again after the commercial real estate lender said it found, quote, material weaknesses in how it tracks loan risks. Herman Chan of Bloomberg Intelligence joins me now with more. And Herman, put this into context for us. Of course, we were waiting for maybe another shoe to drop. How bad is this one?
Right. The disclosure yesterday evening about the material weakness does raise some questions on how the bank is monitoring their loan portfolio, especially with heightened exposure to areas of concern like office, commercial real estate, and rent-regulated apartment lending. So it just adds to the uncertainty and raises a lot of questions on future potential provisions for loan losses. Do they need to add more capital to the balance sheet? Are there more expenses that come because the need to shore up their compliance? So lots of questions still surrounding your community.
Well, the big question is, where does it go from here? I mean, you take a look at shares right now, it's absolutely just a wipeout right now. What does the path forward look like?
It's a challenge, right? The good thing with your community is that they do have a fairly low level of uninsured deposits, so there's not a lot of reason for their deposit base to exit the bank. So that offers them time to really shore up the balance sheet, placate regulators, address the material weakness, and deliver the 10K within the next 15 days.
All right, Herman Chan of Bloomberg Intelligence, I'm sure you're very, very busy on this Friday. Appreciate you spending some of your time with us, of course, as we continue to track the fallout of New York Community Bank. But let's take a broader look at the markets now. We're going to do that with Scott Kronert, Citi U.S. equity strategist. And Scott, it is March 1st, and already we've seen 5 Wall Street firms already lift their forecast for the S&P 500, lifting those year-end targets. You think about the equity rally that we've seen in 2024 so far. Have you been surprised?
Well, I would say no. We went into this year with an above consensus earnings outlook for the S&P 500. So we've been on an earnings resilience theme, Katie, for, months now. And it's been playing out, right? And so what we would argue is that the fundamental foundations for the U.S. equity market are in really good shape, and they support the index price action. What's happened, though, is that this latest rally that we've had has begun to push the valuation envelope a little bit. It's not a big concern for us, but it does, in our view, begin to put more pressure on fundamentals to eventually grow into these valuations.
That's really interesting. I mean, you sound like a bit of a contrarian here, because I have a lot of people come on and tell me that they're worried about valuations at these junctures. But you're saying that if you take a look at the fundamentals, they're close to justifying it.
So it's a matter of timing, right? We're not concerned with valuations. Yes, they're up, and for the big 7, they're probably in the top decile of their past 20-year average. For the rest of the 493 within the S&P, also top decile of the past 20-year average. So yeah, valuations have come up, but generally speaking, when you look at PEG ratios, PE to growth, they've come down. So essentially, the underlying growth dynamic is actually supporting some of this valuation move. That said, we've run pretty far, pretty fast. Our view towards a very strong earnings year for the S&P does have a back half loading element to it. So that's this shorter term issue where we've run pretty hard. We could use some time here to get more evidence of the fundamentals kind of growing into said valuations.
Well, let's talk about tech specifically, because when we look at the S&P 500, its price performance on any given day or week, we tend to be talking about tech, given just how huge that sector is. And when I speak to people about tech, I hear a lot of comparisons to the late 90s, the early 2000s. The word bubble gets thrown around a lot. How are you thinking about the idea that maybe we are in a bubble?
Yeah, Katie, I'm not a buyer of that argument. I do not think that the current circumstance for mega cap tech or big tech or tech in general is anywhere near where we were back in the 98 to 2000 timeframe. I was in the trenches back then. This is markedly different from a fundamental perspective. The quality of the companies, the earnings and free cash flow generation that are driving all of this is the real deal. So that distinction is really important to us. But again, what it does put a lot of focus on is the more you run this mega cap growth cohort around this generative AI tailwind, which we think is for real, the more pressure you put eventually on the fundamentals that come from the investments being made on this to play through. That's going to take some time. It's going to take a year or two, maybe even longer than that. So we just have to allow that there's a very strong differentiation going on within the market right now, which kind of gets to this price target discussion, that the market is, in our view, clearly distinguishing between long-term growth drivers. And where you have that, the market's going to pay for it right now. Where you don't, a little bit different issue. But still, you're going to get to this point here where the fundamentals are going to need to substantiate a lot of these moves.
Well, I'm glad that you brought up AI, because when we talk about the benchmark, we're talking about tech, and when we're talking about tech, increasingly we're talking about AI. So you think about all of the investments that are being made by, the people who aren't necessarily the enablers, the NVIDIAs of the world. You think about the massive spend going on to really develop AI processes. I've brought this up a few times this week, but at this juncture, it feels like this is a margin compression story more than anything. I'm curious about how you feel about that thesis.
Yeah, that's a really good point. I mean, we would, again, probably take a little bit of the other side of this. So the way we've been discussing this and describing it is that there are two dynamics at work. You're going to have those set of companies that have a very clear, identifiable revenue and then therefore earnings opportunity that comes from investment in generative AI. That's where big tech kind of comes in. When we say we're constructive on U.S. equity fundamentals from a longer-term perspective, where we go with this is the rest of the market, where you've got companies that in less visible means are incorporating or will incorporate generative AI into their business practices in a way that ultimately transforms into productivity, and we expect to see it over time in margins and profitability. But again, I'd emphasize over time on that. So two different approaches in how you think about incorporating a generative AI or AI concept more broadly into how we think about stocks in the broader market.
All right, Scott, we're just getting started here. We're going to take a little bit of a break and then talk about something other than tech, so hang tight. Let's take a quick look at what's moving underneath the markets now. We're going to do that with Bloomberg's Denitsa Seikova sitting to my left here. Let's talk about Sweetgreen, because it seems like people are buying those $20 salads.
Yeah, there is definitely some good news on the consumer phones. We look at the earnings report, it looks great. We look at the outlook, there are some positive news for investors, and the price reaction is more than 20%. But there is an interesting breakdown where we're seeing when it comes to consumer pressure, and we have to talk weight loss drugs. There are a few surveys showing that weight loss drugs are actually increasing consumption of Sweetgreen and more healthier foods. So you can see groups like Sava and Sweetgreen really having a strong rally here, while maybe junk food chains are having a harder time. And of course, this boosts the outlook for companies like this, because a lot of studies are actually showing that those weight loss drugs increase consumption of veggies and fruits. So maybe going forward, healthy foods will be the way to go for those chains.
That is hilarious. Wait, so this is an example of positive disruption actually when it comes to these weight loss drugs?
Exactly. People are craving veggies.
All right, we haven't seen much of that. So Sweetgreen obviously seeing a pop on that. SoundHound AI though, not exactly.
Yeah, this is a very interesting story we've seen a couple of times. We've seen stocks being priced for perfection, then an earnings report comes that it's not necessarily a bad report, but the reaction is 20% drop, more than 20% drop. Of course, this comes after a 300% run-up in the stock price. We saw NVIDIA getting a share in SoundHound, so obviously there was a lot of AI optimism in that stock. The revenue jumped 80%, so wow. A solid revenue report, but still not pricing for perfection, and therefore we have a disappointment again.
Yeah, when the bar is that high, it's very easy to disappoint there. Let's talk about Apple sort of getting the boot from Goldman here.
Yeah, so it's no longer the top investment for Goldman. It's still a buy, but it's not making that list. And of course, there has been a lot of news coming around Apple this week, and everyone has been talking about generative AI. They're no longer doing their decade-long product for electric vehicles, and instead they're focusing on AI. There has definitely been a lot of competition, and this is obviously the newest thing. And a lot of people are questioning what can change for Apple and whether the iPhone 16 can in fact bring this extra new thing with generative AI that other phones are maybe not offering at the moment.
It's pretty funny. Still a buy, just not an ultra buy, I guess it's safe to say. Bloomberg's Denitsa Seikova, thank you so much. Now coming up, Dell, the latest stock to be swept into the AI rally fueling markets this year. More on the tech giant next. This is Bloomberg. All right, let's talk about OpenAI and let's talk about Elon Musk. Of course, one of the big headlines is that Elon Musk has sued OpenAI and its CEO, Sam Altman, alleging that they violated the artificial intelligence startup's founding mission by putting profit ahead of benefiting humanity. For more, let's welcome in Ed Ludlow, of course, the co-host of Bloomberg Technology. And Ed, talk me through this because Musk, he has a history with OpenAI.
Yeah, I mean, the simple fact of here is that Musk is basically alleging that this is some sort of illusory promise to all of the original backers of the project in saying that when we founded this thing, we agreed, one, this was going to be a non-profit, and as you said, for the benefit of humanity. It's going to be a really interesting process to see if there's actually any legal grounds at all for Musk to make that argument and what his sort of end goal is here. But I would note the history that Musk has using litigation as a means to send a message, frankly, or to, basically get a competitive edge because, as you know full well, he also has an interest in xAI, which to all intents and purposes hopes to offer exactly the same thing as OpenAI currently does.
That's what I find interesting. I mean, the fact that you have Grok, which is a competing product. I mean, what have your conversations in the past few hours sounded like around that point?
Yeah, I mean, one interesting development, you might call it, this morning is Chamath Palihapitiya posting on X saying, wow, the discovery process in this litigation is going to be so interesting. And Musk replied on X, the platform he owns, saying yes. But what we might learn here as a side consequence of the suit, away from its original intent, I guess, is, well, what happened the weekend that Sam Altman was fired, and what was at the root of OpenAI's board at that time's concern with him? But at the end of the day, OpenAI has been pretty clear about the trajectory it's heading on, that it wants to commercialize its technology, and it's tried in the weeks and months that have followed Sam Altman's departure to explain how the non-profit board oversees a for-profit entity. And there are complications in running a 501(c)(3) umbrella over the top of it. But again, I think, Katie, you and I, it's impossible for us to say, well, what is Musk really trying to do here? What it will come down to is whether there's any legal basis in what he's accusing OpenAI and Sam Altman of.
Well, I won't ask you to read Elon Musk's mind anymore, but just in the 30, 40 seconds I have left with you, talk to us a little bit about OpenAI, because it feels like the fact that it's a nonprofit, that it has this mission for benefiting humanity, this is going to continue to be a sticking point for this company.
Yeah, I mean, a really interesting question that some investors raised with me after we reported OpenAI's latest valuation rounds is, why do they need to raise money? Why do we need to learn about the cap table? Microsoft owns almost half of OpenAI's for-profit structure. But the reality is that they have to make money and raise money because their compute costs are so high. They've kind of put AI as a generally available product for both the consumer and also enterprise and SaaS companies. And that takes a lot of infrastructure to support, and that costs a lot of money. So this will be an interesting sort of existential debate around how they can move forward long term without having a model that requires them to be for profit.
An existential debate. I look forward to having more of those. Bloomberg's Ed Ludlow, thank you so much. Now let's welcome back Scott Kroner, Citi U.S. Equity Strategist. Scott, I won't ask you to weigh in on that existential debate, but let's talk about the market outside of just tech, because if you think back to last October through the end of 2023, we had this beautiful broadening out of the rally, and then the calendar flipped, and it feels like those most bullish fantasies have gone by the wayside. But when it comes to the market outside of tech, do you think that we could get that momentum back?
I think it's a really good conversation point, Katie. The market's broadening under the surface. The percentage of companies hitting 52-week highs, trading above their 200-day moving averages, is all risen quite significantly over the past 3 or 4 months now. Now, of course, it gets masked when you have 3 or 4 of the big 7, really driving the full-year index gains. But under the surface, there are many companies, as I said, that are on really strong momentum plays right now, and I think this continues. Again, it comes back to my earlier point. The market seems to be discerning between longer-term growth trajectories, and if you can demonstrate that, regardless of what part of the market you're in pretty good shape.
In pretty good shape. I mean, what would be the catalyst, though? I mean, is this an earnings story? Is this the Fed finally moving into cutting mode? What would be the catalyst for this rethink and for investors on a broad level to look outside of tech, maybe into some underloved areas of the market?
Yeah, I'll give you a good example. We're overweight industrials, have been for over a year now, very constructive on the U.S. industrial economy. Now, you benefit from things like, global supply chain diversification coming out of the pandemic, some reshoring activities, but you also benefit from increased automation. And increasingly, what you're seeing these companies doing is incorporating their own forms of AI implementation in a way that maximizes their approach to customers and business activity. So we think the industrial economy is in really good shape. And in addition, you're seeing more and more of these companies are actually targeting where a lot of the AI investment spend is going. For example, you build a new data center, you need equipment to support that as part of that build out. They're benefiting from some of these same tailwinds. So we think we're going to see it either from a fiscal stimulus effect via some of the government spending programs, CHIPS Act, IRA, et cetera, investment in AI, but in the meantime, incorporating AI in a way that minimizes the historic cyclicality of those businesses. When you minimize historic cyclicality, the result can be a higher valuation. So that's one example that I think really kind of stands out. I think the retailing part of the market is another example. Here we've moved overweight on U.S. retailers going into this year. Again, same deal. They're going to be able to incorporate AI and related technologies in a way that really influences their time to market with the right inventory at the right place. And we think all of this to my earlier discussion, really begins to set up a broadening array of companies that may not be direct beneficiaries of AI investment, but ultimately become the users of that technology that really enhances their longer-term business trajectories.
Right. Well, I definitely want to get to retail, but just to meditate a little bit longer on that point. So when it comes to AI, we're not just talking about tech here. Some of these physical economy names, too, can see the benefit as well when you think about industrials.
Yeah, so it's a good point. Now, again, to be clear, I know we're talking about the banks here. We're watching what's happening on some of that front. It would be nice to get a Fed pivot to see a lot of the short-term rate plays kind of come down from the perspective that a lot of the investment is predicated on rates that banks charge relative to SOFR, right? So it does become an influence on this. But more broadly, what I keep coming back to is that the setup here is that more and more of these companies we think are going to find ways to incorporate technology, whether it be software, whether it be AI or generative AI components, in a way that enhances their productivity. And again, what we're looking for here is a play-through from a margin and from a profitability perspective. We think this is a big deal as it comes to, let's call it the industrial economy.
And I only have about a minute left with you, but let's talk a little bit about retail here. That overweight on retail that you came into 2024 with. Of course, we just got through the real heart of retail earnings. How are you feeling about that position after what we learned over the last couple of weeks?
Yeah, so, when we went overweight, again, it was back in December going into this year, our premise was that if you go back and look, the real stock price compression in the retail sector happened back in the first half of 22. As the Fed was first moving down a hawkish path, right? And from the middle part of 22 through the end of 23, the retail sector was actually trading sideways, taking all of these stomach punches in terms of consecutive Fed rate hikes sort of in stride. So our view was that a lot of the concern about inflation and then interest rates were quickly being priced into the sector. And under the surface, you did have a spending resilience where we have to acknowledge that the influence of Fed rate hikes has been positive on a certain part of the consumer, i.e. those with savings, because of the money you're earning now on deposits, money market funds, and so forth. And that tends to be the important driver of a lot of the retail sales activity. So we've come at it from a couple of perspectives. We think a lot has already been priced in relative to the Fed inflation and interest rates. We think under the surface, the consumer, even as savings rates come down, is probably in a pretty healthy place for those companies that, require their spending to support fundamentals.
All right, Scott, got to leave it there. Great conversation. Happy Friday. That is Scott Kroner, Citi U.S. Equity Strategist. Now, still ahead, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg. right, time now for Social Climbers. Look at the stocks making waves on social media this morning. And first up, Eli Lilly getting a new injection of confidence. Bank of America raising its price target on the pharma giant to a street high of $1,000, citing more upside for its diabetes and obesity drugs. Here's something you don't hear about a lot: overfunded pensions. Eastman Kodak making the social rounds today after news that the photo company is weighing a pension reversion that would let it tap into the $1.2 billion surplus in its pension fund. And finally, you have EV maker Fisker looking for a financial lifeline as liquidity challenge put its financial survival in doubt. All right, coming up, we're speaking to the CEO of The RealReal. This is Bloomberg. All right, well, real positive growth for The RealReal. The pre-owned luxury retailer stock really soaring after beating revenue estimates in the first quarter. It also delivered its first positive adjusted EBITDA and free cash flow since its 2019 IPO. And you can see the stock there up 42% over the past 2 days. And joining us now is John Koryl, The RealReal CEO. And let's just go over that one more time. We're talking about, again, the first positive adjusted EBITDA and free cash flow readings since your 2019 IPO. Tell us about the journey there. What finally pushed you over the line?
It was a fundamental change to our business. We've always been very good to our consignors, but what we really had to do was concentrate on basically higher value merchandise. We limited some of the merchandise that we were selling for less than $100. As we moved up market, that's actually a more profitable point for our business model. We also stopped buying direct merchandise. So in other words, merchandise that we buy and own instead of consign. That was a necessity that came about during COVID, but we walked away from that. Those were two of the biggest things. In addition to that, we really improved all the operational performance of the warehouse. We're an intensive processing organization with a lot of steps that go into photography, authentication, the descriptions, the storage, the shipping both directions. We improved that a great deal from a profitability perspective as well.
All right, so a lot of actions there, of course, contributing to what we learned and saw yesterday. I do want to talk about this in the context of the macroeconomic environment, and I want to talk a little bit about demand here because there's concerns out there about, of course, a slowdown in luxury spend, in aspirational luxury spend, and, of course, slowing discretionary spend. How are you thinking about that? Do you see that as a headwind in 2024 for your business?
Honestly, we're not seeing it right now. What we are is primarily a supply-constrained business, not a demand-constrained business. So we have excellent sell-through. The only times we really saw any blips recently in demand were in September and then early October, of course, so during the tragic events of October 7th. So other than those things, we've seen really consistent demand. We really cater to that customer who may trade up from a contemporary level product to their first taste of luxury, and we haven't seen that demand slow down at all.
Well, I'm glad that you brought up supply. So if we take a look at your supply side, your inventory balance at the end of 2023 was about $22 billion. I think at your peak you're around $75 million or so. When you think about the right level, where is that threshold when it comes to your inventory?
Yeah, we're really trying to minimize that inventory. We don't go out and consciously buy merchandise with minor exception. There's a few brands, a couple of handbags, a couple of pieces of jewelry that we'll buy and do what we call get paid now. The vast majority of our merchandise is actually consigned, so we're trying to minimize that. What you see there is basically out of policy returns. So what's happened is we paid the consignor for their purchase, and then we get a return unexpectedly. We're trying to do right by both the consignor and the customer. Then we'll take that into our inventory and make sure everybody's happy.
Well, for the select few brands that you do buy directly from, I mean, what does the criteria to get on that list look like?
It has to be very easy for us to take the risk and sell it ourselves. So you won't make as much. In a get paid now scenario in our book of business, you don't get paid as much as we are taking the risk. What we love is we take a lot of pride in the amount of intelligence that we use in terms of pricing our merchandise. So if we price it right, you can actually make a lot more money with us consigning the merchandise versus us taking on all that risk.
And I'm curious, I mean, is that what you're seeing right now, making more money on fewer orders? Because if I take a look at some of the details of your fourth quarter earnings, you actually saw average order value, it grew even as the orders and the active buyers fell a little bit.
Yeah, that's exactly right. Us moving away from that merchandise less than $100, so we started restricting some brands that we wouldn't take as much, and we sort of took the bottom out of our market. And then we actually saw a lot of people moving up into higher price points. So our average sale price and our average order value, and our average order is about 2 units. So both of those actually rose quite a bit, and we've been reaping the benefits of that. So it makes our operation much more efficient as the average order value goes up.
I do want to talk a little bit more about the supply side, really that decision that you made between buying directly from some of these brands versus the consignment model, which is, of course, what you're pursuing now. What are the risks around the consignment model, though? What are some of the decisions that went into that?
At the end of the day, it's a much more profitable model for us, but what we really have to do is make sure we develop a relationship with the customer. We want to be as indispensable as your accountant, your financial planner, your travel agent. Those are the type people that are on the Rolodex of your life. We can do a very good job as long as we form that type of relationship with the consignor. So if we can get to that part of your life, then we have a constant supply of goods. We see a lot of our best clients were in their closet monthly, auditing that closet, finding things that they no longer wear, aren't seasonally appropriate, and we keep going through that process over and over. So it's good for the economy, right? It's also good for the environment, so those goods are getting a second, third, and fourth life. But at the same time, you're freeing up the cash to go buy the next good in the primary market that you want, or there's something that you missed in the primary market you can find on the RealReal that you buy in the secondary market to complement your wardrobe.
I'm also curious to hear your thoughts on the competitive landscape here, because the resale market, of course, it's heating up right now. You do have eBay authenticating luxury goods now. How are you thinking about that? How do you plan to grow and maintain your share?
Yeah, I think competition is an interesting word in our market right now, because with due respect to all those competitors out there, our biggest competitor is apathy or the addict in all honesty. We need more people to be aware that luxury consignment exists. Right now, awareness is only about 40%, and awareness of our brand is about 40%. So as we educate more people on what can be made and that there are businesses around this, the better off we are. So a lot of our marketing dollars not only going to go to educating people about us, it's educating people about luxury consignment in general.
And I mean, before I let you go, I'm curious, now that you've reached some of these milestones, of course, positive adjusted EBITDA, free cash flow readings, what's next? What is your big focus for 2024?
We need to do it for the whole year. We've done it for a quarter. I'm incredibly proud of everything that the team has done. You know, no stone unturned, be it marketing, the stores, the operations, everything. We need to prove we can do it for a whole year. And with the business model changes that we've made, there's no reason that we shouldn't be able to do that this year.
All right, John, really enjoyed this conversation. And of course, congrats on the quarter. You can see that in the stock price today. That is John Koryl, of course, of the Real, giving us a check on the luxury resale market. And of course, shares up over 30% today. And let's broaden out now, though, and get a check on the broader markets. We're going to do that with Abigail Doolittle.
Well, on the week, Katie, we are looking at a bit of a risk-on tone. If we take a look at the S&P 500, a modest gain of up 0.4%, up for a second week in a row. The Russell 2000 really outperforming, up 2.7%, and that's true too. Out of the October low, the Russell 2000 outperforming the S&P 500. Real outperformance from Bitcoin, up nearly 21%, heading to its best week in nearly a year. And New York crude, we're also looking at a nice rally there, just topping above $80 per barrel for the first time since November. This week, up about 5%. So if we take a look at what is happening relative to the Russell 2000, not just from the October low, which is back here, but if we go back to the Russell 2000's all-time high, which was back in 2021, so this is one index which has yet to make another record high to follow the S&P 500 and the NASDAQ. It's interesting to note that the Russell 2000 small caps are down about 15% from their all-time high, while we have the NASDAQ 100, the S&P 500, and even the equal-weighted S&P 500 slightly higher over that time period. And we certainly have the record highs for these three indexes. So the big question is, are we going to see catch-up for the Russell 2000, or is this more of a situation like market turmoil time periods, 2006, 2007, when Russell 2000 small caps were a leading tell on something to the downside for stocks? I would argue that we don't know right now. But one pressure for stocks, although it's not that way at this time, it hasn't come back to this point where we've seen investors fleeing on higher yields in a big way. Take a look at over the last month. We do have that 2-year yield up 35 basis points, the 10-year yield up about 32 basis points. So as these yields pressure higher, that is one reason to keep an eye on that Russell 2000 and see whether it's a leading tell to the downside, or if there is, again, that catch-up trade where there could be significant catch-up trade at some point. We just certainly don't know when that will be. It could be for quite some time. The regional banks, and then of course New York Community Bank Corp, over the last month down about 34%, and much of this happening today, of course, as they've noted, disclosed that they have material weaknesses that, although it won't affect revenue from 2023, and they have made a C-suite change relative to their loans. Well, yes, it is of course all about, or largely about, commercial real estate, with their pressure on that space, with lower occupancy rates and of course rising rates. About $50 billion, the major portion of their pie, then residential, and then other commercial there, and then other loans altogether. So stay tuned for that story for sure, Katie.
All right, great roundup there, Abigail. I know you've been following that story closely. Our thanks to Bloomberg's Abigail Doolittle. Now coming up, we'll hear from Federal Reserve Bank of San Francisco President Mary Daly on how the Fed assesses the neutral rate and how it factors into decision making. That's next. This is Bloomberg. All right, it's time now for Wall Street Week. And the host of Wall Street Week, David Weston, he spoke with Federal Reserve Bank of San Francisco President Mary Daly yesterday about whether the Fed takes into account interest paid on common expenses such as auto loans and credit card bills. Take a listen.
The way monetary policy works is actually you raise the interest rate and that raises borrowing costs and that slows people's spending, and then the economy settles down to a more sustainable pace and inflation comes down. That's how the models work. That's how it empirically works over time. What's different this time is that consumers have just stayed in the game. They continue to spend. They continue to want to participate in the economy, and that's spurred growth, ongoing growth, and that's kept inflation a little bit higher for longer than we would have thought. But I still think overall the news is good. And yes, we absolutely see the challenges that families face when they have to pay higher borrowing costs. But we also know that what they really want us to do is bring inflation down. There is no place I go. I have a very big district, 9 states, but you can travel anywhere in the United States, hear the same thing. What's your number one problem? Inflation.
There is a perception on some people's part that maybe the Fed was a little slow in getting started on the rate hikes, so you could have moved a little earlier. How do you avoid that problem on the way down, being slow on the way down? You said you don't want to hold all the way down to 2% and run the risk of a recession, but how do you know that you're on time with the cutting?
Well, I am deeply focused on that very question because I do think we were a little slow to adjust rates when inflation was gaining strength. But at this point, we have policy in a good place. We can adjust the policy rate down if the economy calls for it. But when you're still adding jobs at 1 to 2 times the rate that you need to keep the unemployment rate stable, when consumer spending continues to be very solid and often more robust than anybody would expect, and GDP growth is coming in so strong, there is no imminent risk to the economy faltering, so we want to make sure we calibrate. So we're balancing 2 objectives. If we let go of the reins on the economy too quickly, inflation gets stuck, and that actually takes that scarring effect we just talked about for people, and they have it for the rest of the decade or 5 years, or it gets into inflation expectations. All those things that we don't want to happen. Plus, it's a very painful tax on those who can least afford to bear it. The other option, though, is we hold on too long and then the economy tips over, which obviously it hasn't done yet, but we want to avoid that. So that is a delicate balancing act, and it's why you keep hearing me and others say we're data dependent, we're not data point dependent, we're looking at the full complement, and we are agile, and we're sitting in what I call the ready position. We are ready to make moves and adjust as the data demand us to do, and I think right now the economy and policy are in a good place to do that.
One of the things a lot of economists say is an overarching notion of how much to hold the reins in or let them go is where the neutral rate is.
Yes, exactly.
And whether the neutral rate is where it's been or whether it's actually going up. There are some who suggest a variety of factors. The need geopolitics, the need to spend more on defense, de-globalization, less globalization. Various factors are really raising the neutral rate. How do you assess the neutral rate, and how does it factor into your decision making?
So the neutral rate is an estimated variable. No one really knows what it is. There's no truth with a capital T. But I do think that we have to be mindful that we came in with a neutral rate that was roughly 0.5, the real neutral. So we'd mean the nominal neutral is 2.5, 2% inflation plus 0.5. So I have in my own head that it's between 0.5 and 1. And that gives you a lot of room to say, yes, those factors you just mentioned could be pushing it up, but we frankly don't know. And so what we do know, though, is that whether it's 0.5 or 1, policy is still tight, and we're still having an impact on the economy that is the one that we would expect. We tighten policy and the economy slows through the borrowing costs rising and the things we already discussed. But so I think 0.5 and 1 is a reasonable span, and if you do that, then we have the answer we need, which is policy is tight, and then we can learn experientially whether it's 0.5 or 1, because we won't know in real time.
When you say policy's tight, to what extent does the real interest rate figure into that? Is that how you monitor it? You basically take a look at the real interest rate and see where it is?
Yeah, so it's a simple back of the envelope calculation, and by back of the envelope, I don't mean that's how we do our work. We do things on the backs of envelopes, but I think seriously, these are very imperfect precisely measured variables. And so you can't rely on them and say, oh, the model says it, so that's how I'll calibrate policy. You have to look around in the economy and be data dependent. But how I would simply do it is if the policy rate's 5.25 to 5.5, and the nominal neutral is, say, 3, then that's a lot of tightening in the system. And so we still have a tight policy stance. So that's what I mean by 2.5 and 3 is not that different in terms of nominal neutral when you have a policy rate that's above 5.
And that was Federal Reserve Bank of San Francisco President Mary Daly and Wall Street Week host David Westin. And we're going to hear more from that conversation later on tonight at 6 p.m. Eastern Wall Street time, of course, on Wall Street Week. This is Bloomberg. Well, the search is underway at Vanguard for a new CEO after Tim Buckley announced that he will retire by the end of the year. And for more on this news, I'm thrilled to say we're joined now by Bloomberg's Eric Balchunas of Bloomberg Intelligence, of course, the authority on Vanguard. You literally wrote the book, Eric, of course, The Bogle Effect. Talk us through the legacy that Tim Buckley leaves upon. Of course, he's been in this post since about 2018 or so.
Yeah, look, I think Tim Buckley's legacy is a big one. The next CEO will have big shoes to fill. Here's why. He basically grew or oversaw Vanguard's assets grow by $4 trillion, which he doubled those assets, right? That's big. I mean, $4 trillion is bigger than, just the growth alone is bigger than most asset managers have total, right? He also really leaned into ETFs, and that was smart because clearly ETFs are the vehicle of choice for most investors, especially advisors. Bogle wasn't into ETFs, so he's yet another CEO that leaned hard into ETFs, made the ETF share class cheaper than the mutual fund share class, which had a lot of investors internally switch over. He also pushed the advisory service. Vanguard investors are getting older, so they started an advisory service to help them manage their money in a bigger way. And that's a cheap advisory service, 25 basis points or lower, depending on how much assets you have. And so some money actually is coming in from outside. And then finally, he rid of a bunch of headaches that the next CEO won't have to deal with. For example, they pulled out of China. Yes, it's a high-growth area, but there's a lot of issues there. And he also pulled out of the climate agreement with those managers. A lot of people have. So the next CEO, I think, is going to have, a lot of things going for them.
And like you said, I mean, Tim Buckley really leaned into ETFs, and now Vanguard really on the heels of BlackRock, which is the largest ETF issuer. That gap has really, really narrowed under his reign. Would you expect that the next CEO, similar to Buckley, would keep that as a core focus of the business?
Yeah. Look, when you walk into Vanguard now, if you're the CEO, everything's going well. Don't rock the boat, right? Keep it going. Here's the one big thing they got to work on: customer service. If you go to Yelp reviews or the Bogleheads forum, they get ripped for this constantly. People long wait times when they call in because Vanguard doesn't have that much in revenue because they don't charge a lot. So you have little money to work with, and you've got to do better customer service. This is their Achilles heel. So the next CEO, I think, should make this their legacy: customer service and technology. I think that's where they can improve greatly. The asset management stuff almost takes care of itself because of Vanguard's brand and reputation and momentum.
I love to think of you just scrolling on Bogleheads. I know that that's how you spend a lot of your time on that forum there. But talk to us a little bit more about who the new CEO could be. I know that you told Bloomberg News that you're expecting an internal hire here.
Yeah, look, they already, Greg Davis would be somebody I would think of, and in the press release they pointed out that he's going to be president. He's a very good guy. He's kind of the face of Vanguard along with Tim Buckley. I'm sure he'd do a great job. I can see Vanguard hiring internally. You know, every CEO up to this point has been one of Bogle's former assistants, so they love to keep it in-house. That said, because of the customer service issue, and I would also add maybe how do you market to millennials and Gen Y, they might want to get somebody from outside. That would be interesting.
That would be interesting, but it makes sense. Maybe they'll keep it in the family here. It'll be fascinating to watch. Eric, I know you're going to be all over it. That is Bloomberg Intelligence's Eric Balchunas. And of course, you can catch me and Eric every Monday on ETF IQ at 12 p.m. Eastern. You can really bet on the fact we're going to be talking about this on Monday. But before we go on Bloomberg Markets, let's take a quick look now at some of the stocks hitting highs and lows on this Friday, the 1st of February. We're going to start with Autodesk hitting 52-week highs. That's after it reported fourth quarter results that beat expectations. You can see shares are up about 2.2% right now. Next up, you can see there we have Advanced Micro Devices, AMD, also hitting fresh highs. The chip maker seeing its market cap close to above 300 billion times for the first time. Earlier this week, Citi wrote that it is, quote, wildly bullish on semis thanks to AI demand. You can see AMD currently up about 2.7%, and that market cap, it's not quite NVIDIA levels, but of course it's rising pretty significantly in this AI craze. Let's go to the other side though, and let's take a look at some 52-week lows, because meanwhile you have Xcel Energy. It's sinking the most since 2020 after a law firm said the utility company might be linked to the Texas wildfires that are ravaging the state, and you can see that showing up in shares in a big way. Over the past 2 days, it's down about 14%. But coming up, moving forward, the Autodesk CEO, he joins Bloomberg Technology with Caroline Hyde and Ed Ludlow up next. That's at 10 a.m. New York time. But that does it for Bloomberg Markets. Have a great weekend. This is Bloomberg.
heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, Elon Musk sues OpenAI and CEO Sam Altman, alleging they violated the company's founding mission by putting profit ahead of benefiting humanity. Full coverage ahead.
Plus, we'll have full earnings coverage ahead and sit down with the CEO of EV maker Fisker. Shares are absolutely plunging and the company's survival is in doubt.
Meanwhile, we'll bring you the takeaways from Mobile World Congress over in Barcelona. That's as smartphone makers, particularly Chinese ones, are touting their AI capabilities. Where is Apple? When will it join the rivals in debuting that sort of tech? But first, let's check in on these markets. And as we talk, new day, new month, and we're still all about technology investing. And we're up about 0.5% on the back of the NASDAQ. We're actually seeing a little bit of a pullback when you're seeing on the 10-year yield, down much more, like 7 basis points once again. Are we seeing perhaps a little bit of weakness in consumer sentiment? Ultimately, some of the economic data today, which really shows maybe we won't see the Federal Reserve having to pause on their cutting focus at the moment. But it's interesting that there isn't just a US rise in terms of equities. We've seen Europe once again at a new record high. The MSCI All Country World Index on the higher side, in fact, at a new record high as well. China did well. Some of their economic data still showing contraction, but not as bad as had been expected. So we're up about 0.5% when you're looking at global stocks today, Ed, for this new day of a new month. Moving on, have a look at what's happening in the world of crypto. What's it up to on the first day of March? We're actually still managing to push onto a 61,000 level that we're just a little bit lower on the Friday, but it has been a stellar week for this particular asset, and we're up almost 20% over the last 5 trading days. And remember, it doesn't sleep on the weekend. What have you got coming up?
There is so much to discuss in the program in the earnings context. Dell, one of the big moves to the upside. Everyone's woken up and has learned that Dell does more than just make PCs. We know the story that AI infrastructure build-out's well underway. They also do servers and server designs too, and the street really likes what they had to say about that, getting a lot more love for their AI story, even if there's still some jitters around their PC business on the consumer side. Later in the program, Fisker's CEO, Henrik Fisker, is going to join us. The stock it's down 45%, a going concern. They're cutting 15% of their workforce. They're giving us a really conservative number for deliveries this year. It's a company that's nowhere near its peak or heyday after it went public 2021. We have so many questions for Henrik. And if you're watching right now, come to Caroline and I on social media. Give us your questions for Henrik, because there are many to be answered. Also looking at Microsoft, I'm not saying this is a causal link. I'm saying it can be. Microsoft can be a proxy for investor sentiment towards OpenAI, because Microsoft owns 49% of the for-profit side of OpenAI. And we have our top story coming, but I'm noting the shares are a little softer, and it's important what we're about to discuss, Karen.
It is, and let's dig in, because we're talking about Elon Musk, how he is suing OpenAI and its CEO Sam Altman, alleging they violated the artificial intelligence startup's founding mission by putting profit ahead of benefiting humanity. Now, the lawsuit was filed late Thursday in San Francisco. It states that the company's close relationship with Microsoft has undermined its original mission of creating open source technology that wouldn't be subject to corporate priorities. I'm pleased to say our Elon Inc. expert, Matt Chafkin, is here with us. And look, he's not the only one who said this. In fact, Kai-Fu Lee told me a couple of weeks ago that he thinks OpenAI should be called and rebranded Closed AI. But he is one of the most vocal critics, having been an original founder and donor.
Yes, and many of the points that are made in this lawsuit, Elon Musk has been making for months. He has been complaining, number one, hey, I put a lot of the money into this thing. I think the lawsuit says $44 million over the first few years. It was partly my idea. You recruited all these people, on the strength of my personality, and the promise was that this was going to be a open source, a thing for the benefit of humanity, and now look, it has a very, very valuable deal with Microsoft, huge revenue, sky-high valuation. Sam Altman's going around talking about starting even bigger ventures, and Elon Musk is sort of asking, and has been asking for months, how did this happen, and as he has said on podcasts and so on, is this even legal? Now, I should say, this is at least partly a stunt. Elon Musk has a competing company, xAI. He is doing